Constitution 122nd Amendment Bill in relation to the Goods and Services Tax has been listed for consideration and passing in this session. If enacted, the GST would subsume various existing central and state indirect taxes. This would include the central excise, sales tax, entertainment tax, octroi, etc. Under the existing indirect tax regime, some of these taxes follow the VAT principle, like in the case of central excise and sales tax. What this essentially means is that tax is levied only on the value added to the good during the various stages of production and distribution. However, not all indirect taxes follow the VAT principle. In cases where it is followed, the input credit is not available across the central and state taxes. This has resulted in multiplicity of taxation and cascading effect of taxes. The bill enables Parliament and state legislatures to make laws for the levy of GST. Additionally, the centre is permitted to make a law to levy what is called the integrated GST or the IGST for interstate movement of goods and services and imports. The bill also creates a constitutional body known as the GST Council, comprising of representatives of the centre and the states who will make recommendations on various aspects in relation to the implementation of GST once GST is rolled out. Compensation will be provided to states for a period of up to 5 years for any loss of revenue that they may face as a result of the implementation of GST once it's enabled. The bill also states that alcohol for human consumption has been exempted from the purview of GST. In relation to petrol and petroleum products, GST would be levied on them at a later date to be decided by the GST Council. Some have argued that exempting products from the purview of GST could result in cascading of taxes. The centre is permitted to levy an additional tax of up to 1% in the course of interstate movement of goods. The revenue accrued from this tax will be directly given to those states from where the supply of the good originates. It could be argued that this provision of 1% tax deviates from the objective of GST, which is that of creating a harmonized national market. This is because if the 1% tax were to be levied, a good that was made and sold in the same state would be cheaper than that which is transported from one state to another. The Select Committee that examined the bill submitted its report last week. The Select Committee agreed that this 1% additional tax could result in cascading of taxes. Instead, it recommended that this tax be levied only when there is a supply of good from one state to another in the course of its sale and not stock transfers. For more information on the bill, please visit our website at www.prsindia.org.